Hello everyone, welcome back to the channel. Today we're going to take a deep and clear look at the gold and silver markets, what is driving prices right now, why the market is behaving the way it is, and what different types of buyers and investors should keep in mind in the coming days and weeks. This update is especially important because we are at the very start of a new year, right after one of the strongest rallies precious metals have experienced in decades. After such a powerful move, markets naturally enter a phase where things slow down, emotions change, and price behavior becomes more complex. So in this video, I'll break everything down step by step in a simple and practical way so you can clearly understand what's happening and what really matters right now. As we move into 2026, both gold and silver are trading at historically strong levels. Gold is holding firm after a powerful move higher last year. Even though we are seeing some short-term fluctuations, gold remains well supported and continues to trade comfortably above key long-term levels. This tells us that the broader structure of the market is still intact. Silver, on the other hand, is showing much higher volatility. Prices are elevated compared to previous years, and daily price swings are larger than what many investors were used to in the past. This kind of movement is normal for silver, especially after a major rally. Silver has always been a faster-moving market compared to gold, and that behavior becomes even more visible after strong upside momentum. At these price levels, it's important to understand that price movement is no longer smooth. The market is no longer driven mainly by small retail buyers. Instead, it is being influenced by positioning, profit-taking, and large institutional activity. This is why sudden moves up and down are becoming more common. Right now, the overall market direction can best be described as mixed but volatile. On one side, gold and silver are still supported by strong long-term fundamentals. On the other side, short-term traders and large funds are adjusting their positions as the new year begins. This combination creates an environment where prices can move sharply in either direction without forming a clean, straight-line trend. So instead of asking whether the market is bullish or bearish, the more useful question right now is how much volatility the market can absorb before it chooses its next clear direction. This is a phase where patience becomes more important than prediction. There are three main forces driving gold and silver prices at the moment. The first is safe haven demand. Global uncertainty continues to support precious metals. Whenever investors feel unsure about the economy, geopolitics, or financial markets, they naturally move toward assets like gold and silver. Gold benefits the most from this behavior because it is widely seen as a store of value during uncertain times. The second force is institutional position adjustment. At the start of every year, large funds rebalance their portfolios. This means they buy some assets and sell others, not because of fear or optimism, but because of predefined rules and allocation requirements. This kind of activity is technical rather than emotional, and it often creates short-term pressure even when the long-term market outlook remains strong. The third force is silver's dual role in the global economy. Silver is unique because it is both a precious metal and an industrial metal. Long-term demand from technology, energy transition, and manufacturing continues to support silver. However, because of its industrial nature, silver reacts more aggressively to changes in global growth expectations. This is why silver often moves faster than gold, both on the upside and the downside. One important market development to keep an eye on is portfolio and index rebalancing by large institutional players. When major commodity indexes adjust their weightings, funds that track these indexes are forced to buy or sell contracts regardless of price. This can create temporary selling pressure even when the overall market trend remains healthy. Movements like this do not mean the long-term story is broken. They simply mean the market is digesting previous gains, and experienced investors understand this difference very well. Looking at the short-term outlook for the next few days, continued volatility should be expected. Gold may move sideways with sudden spikes higher or lower depending on news headlines and currency movements. Silver may experience sharper pullbacks followed by quick rebounds, which is typical behavior after a strong rally. Short-term traders should remain cautious because false breakouts are possible, emotional trading can be costly, and risk management matters far more than trying to predict every move. In this environment, the market is rewarding patience more than aggression. If we zoom out and look at the medium-term outlook over the next few weeks, the picture remains constructive. Gold continues to benefit from long-term store of value demand, ongoing interest from central banks, and persistent global economic uncertainty. Silver continues to benefit from industrial demand, supply constraints, and its strategic importance in future technologies. While pullbacks can certainly occur, they are more likely to be corrective pauses rather than full trend reversals. Even for viewers who are not technical traders, it's helpful to understand that the market is paying attention to certain areas. In gold, buying interest has appeared near previous consolidation zones, while resistance tends to show up near recent highs where profit-taking becomes more common. In silver, support levels are wider because of higher volatility, and resistance zones are tested more frequently as silver attracts momentum-based trading. These levels matter because they influence trader behavior, not because they guarantee future outcomes. Different types of viewers should approach the market differently. Short-term traders should keep position sizes smaller, expect sudden moves, and avoid emotional decisions. Volatile markets can offer opportunity, but they also punish overconfidence very quickly. Long-term investors should focus on the bigger picture, ignore daily noise, and view pullbacks as a normal and healthy part of a broader trend. Gold and silver remain strategic assets, not short-term trades. Physical gold and silver buyers should avoid chasing prices on strong up days, consider staggered buying, and focus on value rather than perfect timing. Physical ownership is about protection and preservation, not daily price movement. Overall, the market is currently in a transition phase. It is transitioning from an explosive rally into a more selective and cautious environment. This does not signal weakness. Instead, it suggests that the market is becoming more mature. Strong hands are holding their positions, while weaker hands are being shaken out. This is often how sustainable trends are built over time. To summarize everything clearly, gold and silver remain strong assets as we enter 2026. Short-term volatility is normal and should be expected after such a strong rally. Long-term fundamentals remain supportive. The key message for today is simple. Do not confuse short-term noise with long-term direction. Markets move in cycles, and patience continues to be one of the most valuable tools an investor can have. That's it for today's detailed gold and silver market update. If you found value in this analysis, don't forget to like the video, subscribe to the channel, and share your thoughts in the comments. Thank you for watching, and I'll see you in the next update.